All right, good evening, everyone, and welcome to March's speaker series. In addition to this week's in-person session, the cohort. It's great seeing all of you. For those who haven't attended one of these in the past, the Dirigo Lab Speaker Series is a monthly event where founders and leaders share insight on how they overcome challenges, capitalize on their target market, and develop their products, providing you with actionable insight for your own products and processes. For more information, you can find us on social media or online at centralmaine.org and dirigolabs.org under our Speaker Series tab. I'd like to thank our sponsors for this evening's conversation. This free event is presented by Dirigo Labs and is sponsored by CGI, Valley Beverage, Thomas College's Harold Alphon Institute for Business Innovation, and Bricks Co-working and Innovation Space. In addition to everything I just said above, this conversation is being recorded and will be available for later viewing on our YouTube channel. I would like to introduce Brian Walker, who will be giving a presentation tonight on behalf of the Maine Angels. In this speaker series, Brian will discuss how angel investment groups utilize due diligence to understand the potential risks and benefits associated with funding startups and entrepreneurs. And for those who are not familiar with Maine Angels are accredited private equity investors who invest in and mentor early stage companies. Their goal is to make investments in promising entrepreneurs in Maine and New England. And with that, I will pass it to Brian.
Thanks, Sabrina. Thanks for having me, everybody. And it was really fun to get that update, because as much as I'm just kind of parachuting in, like some of the things you're working on, the overlaps with some of the things I'm going to talk about, it's like you guys are already driving down the road. So that's a really good sign in terms of some of the experiences you've had. I'm going to stay here as much as I don't like this distance, because Mr. Owl is, I think it's better for somebody to see my face than the back of my head, although many people might disagree. But I think I'll stay on this side and then I'll try to move around. But
you're projecting wrong.
Oh, good. Okay, that's good. Yeah, that's one thing nobody's ever criticized my voice being too quiet, I guess, small package, big voice. I'm going to just run through a few things, and let's see. I'm going to turn this thing on. I actually have this thing in my hand, which I thought was on, but it decided to go to sleep. Just so I don't have to keep it down. This is an easy thing to do too. This is the agenda. Very simple. I want to get acquainted quickly, and I've already feel like I've got a sense of that. I did a lot of pulling of things off of the Dirigo Labs website and the like. Then the meat of this is about due diligence. How does it work? And then I want to leave plenty of time for questions. And as a matter of fact, what we'll do, we'll stop along the way just so everybody gets a chance to ask questions if you want. So really quickly, if you can see this, I'd be interested in finding out which of these numbers most closely matches where you are. So everything from you have an idea, but you haven't really gotten to a place where you're thinking about it in terms of getting to or being close to minimum viable product, to actually having revenue, to something else that you're doing, that you're playing a role in the startup world, but you're not an entrepreneur per se. So, and I know, we've got Laura and Lisa and Patrick and Hannah and Patrick on the phone, so they can, I don't know, maybe you can help me with that part of it. We'll give you guys a time to get there too, so hopefully you can see it. But just a show of hands, how many people are at that place where you have an idea, you're working on developing that idea into a business, but you're pre, I'll call it minimum viable product, you're pre having that place where you're going, yeah, this is going to work. Show of hands. Okay, so this is seasoned vet. See, this is good for me to know. How about the business? You're getting closer, you're at minimum viable product, you're pre-revenue. Okay, great. And then third, you have a proven minimum viable product and you're about to or are generating revenue. So most of the other, okay, Jake, thanks. Okay, great, awesome. And then you play a role in the startup world, but you're not currently building a business, just other people that are interested, because I know it's an open house type thing. Thanks, Donovan, I appreciate that. That's good. Okay, good. Good for those. And you don't fit any of these categories? Anybody else want to just offer up? And the reason I'm doing this is so I can kind of tailor comments to fit, right? I don't really need to talk. Since there's nobody up here, that means that we can go a little bit more, we can just get into second and third gear real quickly. I'm going to be in my automotive metaphor. And how about the folks online? Hannah, I know, and I remember working with you at at Top Gun, and so I'm going to guess that you're a solid 3, that you are generating revenue, correct?
Correct.
All right, Laura and Patrick with gel hydration. Where are you guys in the journey?
So we used to have a co-packer, then that was impacted by COVID. So now we moved into our own factory and are working close to get our product created on our own.
Okay, so you were moving, and then you kind of took a step back to kind of now do your own production and the like.
Correct. Mm-hmm.
Cool. Lisa, where are you in this journey?
You're on mute, Lisa.
Getting them on mute. I'm a number 3. I've already started generating revenue.
Excellent, excellent. And Patrick, Karen?
Also a 3 as well.
Excellent, good. Did I miss anybody? All right, that's really helpful for me. Thank you very much. All right, a little bit about angel investment groups. And again, I'm starting to feel like you guys are a little further along on some of the stuff than sometimes we talk about. So we'll do this really quickly. We generally are investing it, and I'm in an angel group. We'll talk about that a little bit on Maine Angels, but we generally invest at the pre-seed and seed stages, so early investment. And we'll talk a little bit more about that because I've already heard words and names bounced around about, kind of that I can help kind of set where we fit in. We're comprised, the members of Maine Angels or members of angel groups are what's known as they're accredited investors. And listening the other night, it sounds like you're already getting into debates about it, what you had to actually get to prove that someone's an accredited investor. But basically there's thresholds that the FCC has set up that are either income or network based or expertise now. But we're all of our members are that, so it makes it a little bit easier for you guys if you're coming to us to know that if your Maine Angel members have already been vetted in that area. There's about 20 angel groups in New England. There's about 260, 280 in the United States. It kind of fluctuates. We have relationships with most of those 20 because we do things called syndication, where we're taking a deal and they're coming to us or we're coming to them. So that adds kind of a multiplier effect in terms of the kind of money that can be raised. And our group is about 80 investors, mostly, but not all from Maine. COVID was a really interesting time, and it meant that some people who had kind of summer homes up here decided to become members, and then some people left Maine, but have continued to. So we use hybrid meetings and the like. So it's added and extended our group. We have a portfolio of about 60 companies. That means that we've had more, but we've had exits. So there's about 60 active companies, and we've invested about 38 million since the group started in 2005. Here's some examples of companies that are in our portfolio. And I chose these particular companies because I was hoping to get some that you recognize and maybe some that you don't. And also to kind of make a couple of, I think, key comments. One is, we are not, some investment groups, angel groups, especially as you move towards Boston, for example, where there's quite a lot of them, New York, obviously Silicon Valley, even Austin, they tend to become more vertical. So that, if you're a high tech or fintech, you might be a particular group that has that as a focus. So, for example, Boston Harbor Angels, which is in Boston, that's pretty obvious, tends to do a lot of biotechnology investing. Not exclusively, but they do a fair amount that way. We're not. We kind of go all over the place. And with 80 members, we have interests. People have particular interests. And so as long as there's interest in the deal, we will work it. If you look at this, and I know a lot of these you probably don't recognize, it goes everything from innovative toys to aquaculture to bioscience and technology to SaaS models to food products to women's care products and let's see, what have I missed? And yeah, a fair amount of technology in there. Most of these are Maine-based, but not all of them. We tend to invest primarily with New England companies, but not exclusively. If we have a good contact or connection, we do have a number of companies in the portfolio that are from the Pittsburgh area because there was some very good relationships with some of their medical companies that are down there that we're generating out of Carnegie Mellon University there, which is a kind of a little bit of a hot spot for that. So those are in there, and fair amount from, about 60% of our investment is Maine, and about 75% of the companies are from Maine, and probably 92% are New England. So just give you kind of an idea where we're at. I wanted to just mention these, and you guys have already started mentioning these, and I know you heard from Nina and Joe at NBF a week or two back. These are folks that we work with a lot. And the great thing about Maine is the 3 degrees of separation. Someone mentioned that on the phone the other day. Very, very tight connections between people, excuse me. And so we work with these folks a lot. We share information. We also try to support, once we're gung-ho about somebody, we try to make sure that these organizations are as well. MTI, Maine Venture Fund, and CVI, which is the CEI Ventures group, which is also doing investment. And CEI also can be of value. I wanted to take a moment on this area of, where do you go for money first? And Mark Johnson on Tuesday was talking a little bit about different places and who's the right people and the like. And there was a guy named Don Gooding. He used to, Don probably really well. That's right. I just realized that actually. 1 degree of separation in Maine. So Don at one point was the chairman of Maine Angels, and was also very involved in the community, and came up with this idea of 4 colors of money. And his point was, as Sabrina introduced me, it says we're equity investors. So that's what we do. We may take a convertible note to start with, but ultimately we are going to take a piece of your company, and that's expensive. So the point here is, don't start with angels, don't start with equity investing. Find all those other things you can do first. So if you kind of start the wheel and you start at 12 o'clock and move around, bootstrapping is a very powerful thing to do. I know everybody can't do it with their own personal money, but finding people that say, yeah, I'd be interested in investing. Why? Because first of all, it's early money. The further you get your company along in the progression, the less you have to give away. It also says to people like us that you have faith and you have commitment. And when you have money invested in the business, whether it's your mom and dad's or yours or your friends, you are more likely to stick through the dark times. And so one of the things we're looking for is perseverance. Will the founders be willing to stay with the company when the times get a little bit tough? So sometimes you can take on personal debt. It depends on what you have to collateralize homes and the like. I'm not suggesting you do that. I'm just saying that those kinds of things are ways of kind of demonstrating your belief in it. And one of the things that's coming along now more and more is crowdfunding. And Blue Shift was an example of an organization who decided to really go in that way and has done very, very well. Sasha's a great promoter too.
I was hoping that would come up. We've been thinking about crowdfunding as well.
Yeah.
I'm curious to know why it would be in the bootstrapping section here. It feels like things like WeFunder or other areas where they're actually taking equity and giving something up.
Yeah, no, that's a good point. You could move it over to equity. I think of it as being early stage, and that it's relatively small amounts, and sometimes you're utilizing something. It can be something other than equity that you're providing.
Products you can pre-sell.
Exactly. Yeah, and it can even be something where you're guaranteeing a certain return on a debt instrument if you want. But it's a good point. Crowdfunding probably is one of those ones that can kind of wrap around, frankly, not grants, but in other places as well.
Yeah, I mean, there are crowdfunding resources for people that's more in the nonprofit sector, whether they're just giving money to you because they like what you're doing and they want to support your cause.
Right.
But that's different than what you're talking about here, I think, which would be raising money for a for-profit business.
Yes.
A little more complicated with equity and product sales and that kind of thing.
Yeah, although I would also say the earlier on in this journey, if I was to take the continuum I love working with continuums, but if you took angel groups in general, there are people who are angels who are pure ROI. They're looking for a return on investment, period, plain and simple. There are people who are almost pure funding because they believe in a purpose. And then I would say I'm one of those people that tries to bring both of those things into the equation. So there's that aspect of it too. But it's a good point. It may be better over in the equity side because often you are providing some type of small percentage back on it.
I think it's a good strat solution. I'm actually still a little bit uneducated on like what different crowdfunding models are out there and which one's right for the right situation. So part of this is just kind of asking out loud, like,
yeah, no, it's,
which one of those fits into.
and I wish I was a little bit more versed on it. I know the one that Sasha used was, I think, I think it seemed like a fairly good model that was designed so you could use Kickstarter, but it's really not designed for that.
Yeah.
Whereas there are a number of them that are out there now, because you do get into some interesting things because you suddenly could have this burgeoning cap table, for example, which would be like a nightmare, right? Yeah, exactly. So there's just some things you can do with that, but I'm not as up to date on it as I probably should be. But I do know it's being used more and more early on, especially for some of the funding. I mean, I think Sasha probably broke some records with what he actually was able to do. On the next place that I would suggest going is grants, and grants are amazing because there's a lot of them out there, and that was one of the things I heard. I heard the word grant being mentioned before, and going for that. Even if you don't get the grant, going through that process of saying, okay, how do I take my business and communicate it in such a way that it's going to be relevant for whatever grant I'm being given is a great exercise. It's just like developing a pitch deck. All of those things are great exercises, and they're different vantage points that you're taking to talk about your business. It's going to make you so much better and on your feet if you have to talk about something. A question comes up. We ask a lot of questions. By going through those processes, you're always going to get better at what you're doing. And within the Maine world, there's SBIR and STTR loans. Karen West is with MTI. Phenomenal resource. If you've never worked with Karen, I'm sure you will at some point, but she can tell you the ins and outs of how to get that federal money, NIH monies. FAME has some grants and the like. MTI obviously has grants. Those are all things, by the way, as angels, we go, oh, they were able to get that grant. That's a real plus because it says that somebody's already done due diligence and allows them to then be that much more, we're that much more assured by the fact that, people that we respect and trust have gone through the process of looking at your business and are seeing that this is a valid idea. So, I think Mark talked about this a little bit too. He had a comment. I just wrote a note. Said Mark Johnson spoke about this on Tuesday, starting with bank loans. And I think bank loans are an interesting idea as well in terms of that would really be in the debt area. But if you can get bank loans, it's a good way to again not give away a piece of your business until you have to. And I'm not saying that you're never going to need equity, but what I'm saying is the further you get along on that journey, back to my 1, 2, 3, 4, right? Every time you go a step up on that and you're now post-revenue and you're starting to get traction, you've just de-risked your business. If you've de-risked your business as an investor, I look at it and go, right, well then I'm willing to either give more or give more for less money back, right? It's a risk return. That's all we're ever doing is just figuring out risk return. So the more you de-risk, the more you'll have the more of your company you'll keep. So, and then lastly, there's the area we play in. So whether it's angel investors or venture capitalists, private equity, family, what's the word? Family offices. I think it was family farms that kept going in my brain. All of those are places that you can go. I found very interesting in Mark's comments about that idea of really starting to think about early on, who are those people that would be interested in my business and starting to create the relationship. That is one of the things that I always say is make the relationships as early as you can. Even before you want the money, is start the relationship, because we're human beings. The more we have that human connection, the more likely we'll be interested in having the discussion. So this is that kind of that circle of the wheel. Make sure that you go through that process of keeping yourself whole, you and your founders whole as much as possible, and move around and look for those other options. And if those things have been added, then we're going to be in that much better shape.
Sure, for you, we make renewable diesel. So, I am now working with, Amtrak and a couple of other companies to buy our fuel.
Mhm.
So how do I leverage a bankable offtake?
It's a good one. It should be able to be collateralized.
Yeah.
Would be my thought. And I would say that some of the banks that I have seen, like I won't say names, but there are a lot of good local/regional banks in Maine that seem to be very open to those kinds of things. I would think that in other words, you're needing money to get the fuel in so that you can then sell. If you're able to show a contract with Amtrak, for example, I would think that would be something you could collateralize.
Maybe go to the Green Bank, okay, I got this.
Yeah, that absolutely. Yeah.
But maybe confiscatory rates though, right?
What was that?
Confiscatory rates really high.
Yeah.
So you can get loans against purchase orders, but
Yeah.
really
That's
incredibly
killer.
expensive.
That's killer. Yeah, we have a couple of companies that have had to go do that, and it's I'm not sure why that's legal, some of the levels that they have, but so that's true. That may be because that is a promise of a payment.
It looks good to the investor, but
Absolutely
you need
does.
money right now. So
Right.
how do you leverage against
Yeah.
that?
Well, and there's both the short term and long term. If you're working with angel investors or private equity, like that tends to be a longer time frame mentality that they have. So it might be the kind of thing when we get into uses of funds, you might say we're going to use a small amount of this raise in order to get the fuel that we're going to be needing for this. But here's the long picture as an investor. Because for us to tie up money for 5 to 7 years, we're looking for a long-term return. And so therefore we would not be, for example, looking at a fuel purchase as something that we would probably fund. If it was part of something that got you over to a hurdle that then opened up or did an unlock for a larger opportunity, then it might be something we would see as, okay, if a small portion of that's going for that particular purpose, that makes sense then.
Yeah, and if you have a bank that comes in that position, and so let's say I have a 5-year note, and then I go get a 5-year offtake agreement, then people are gonna know I'm gonna be able to pay that,
Right. That's
so
a good point.
it might help me secure something.
Yeah. I'm not as up on debt as I would like to be in terms of some of the ways that you can do that. And Susan's right that those are very high rates. And now that I think about what it would actually be that you'd be getting. Yeah.
Valuation. I don't know if I can ask that here.
Yeah, absolutely.
So I'm seeing this bootstrapping grants, which I'm very much in the process of still 5 years. And a little bit in the debt area. We have a small $5,000 debt. And actually to that point, I think what was really helpful for us talking to the bank was just understanding what they like to provide loans for. And they provide loans for seasonal businesses to make it through the winter so that they can make money in the summer. And so that was exactly what we needed it for. And so I think they probably stretched their comfort level with a small loan based on our ability to make the money back seasonally. But in terms of where I know there's not a cookie cutter answer, but if you were to look at a business and say, okay, they're like a quarter into debt and they've done bootstrapping and they've done grants, or is there a certain valuation that you feel like the company should be meeting? And I've never done an official valuation of Farm Drop and I need to do that. But do you see a company at a valuation of about, I don't know, $750,000? Or does it really depend on the sector and what it's doing?
I would say that generally angels become interested probably about 750 as a valuation would be at the lowest end we would probably see. It would be, and we might also look at it from what's the raise, what's the amount of money you're looking for, especially in that ratio between valuation and raise. Most of the companies we're seeing these days are valuations are going to be coming down a bit, but there probably have been in that range of 2.5 to $12 million kind of range, you know, a pre-money valuation. That is partially because of where Maine Angels is. I would say if you took all the angel groups in the country and put them on a continuum, since I love those, we would be more conservative than the average angel groups. So there would be angel groups that would probably be getting in very, very early, where your valuations are very, very low. We would tend to be probably a little bit later.
And is there a correlation between, like you could have a $5,000 grant and a $5,000 debt and be at a very low valuation through, you know, all the way up to, but in order to get equity, does it feel like there needs to have been a certain volume in each one of these quarters?
No, it doesn't matter. As a matter of fact, grants, we love things that are grants because they're non-dilutive, meaning that no one has taken any part of you. You know, obviously debt is something that has to get paid back and it's at the top of the capital stack. So it supersedes anything that we'd be investing. So grants we actually like to see because it's both a seal of approval or endorsement, as well as not being dilutive. I would say that, what was I going to say? I think it has more to do with where you are in that development curve than the financials. I would leave the financials off to the side to an extent. We do have people who come to us and they're looking for $20,000 or $10,000. They have a small business and they're trying to do something with it. For a number of reasons, generally, those are things that we wouldn't look at, generally because they're not angel type investments. We'll get into what angels are looking for. And one of the things that angels are looking for, in order for us to tie up money for a relatively long time, that's going to be totally illiquid. Remember, if you go and buy some shares of Microsoft today, and you decide you want to sell them tomorrow, you can do that. There's an open market for it. This is a very different situation. When we put money into a company, it's locked in there until some type of event occurs where we can get our money back out. And so we're more interested in kind of where the business is in its development. So back to that kind of idea of, you know, your pre minimum viable product. I would say that we generally don't go into companies that are pre-MVP unless there's something that has to do with intellectual property that we think is very exciting. So that happens a lot in things like biotech. That's one of the places that we would be. So I've been in a company for 4 years that's still pre-revenue, and it will be for a while if it goes anywhere. So that's, but that's the reality of that particular business. So we would look more to seeing where are you on that path to ultimately getting to a place where you have a product or service which you can command revenue for. And if that all makes sense and that trajectory looks like it has potential, then that's how you would value, you know, that at a point, and you can. And I would be very happy to look at any business anytime and say, here's where I think you're at. We do that a lot with people. And again, often it's going to be too early, but if you start the relationship and then we see that, you know, wow, you said in a year you'd be at this kind of point and you are, and then that also helps.
Thank you.
Another question. For you.
Yeah.
We got a government grant, we're gonna be doing PFAS remediation, there's likely some IP that will come from that. How can I leverage the IP? Yeah,
so monetarily, I'm not sure how you can do it. I don't think you can take it to a bank, but if you were to if you've got IP that's coming, then you want to get to at least a place where you've got a a provisional patent. Thank you. We have people who are really good at this, and I'm not one of them. But if you get to a provisional, at least if you made the application for it, then that is a very powerful. That's a very powerful in terms of evaluation. That would increase your potential for having a higher evaluation. So it would also increase when we might become interested in what you're doing, because IP is one of those places where in certain places, it's not a be all and end all. I think it's sometimes people go, "Ooh, you got IP, that's great. I'll invest." But it, along with a number of other things, can be something that can be very compelling as an investment.
Do you have any advice as to, with this intellectual property, I actually have a company, a military contractor that is interested in sharing that. How do I value them and get money out of them early?
Yeah.
I mean, that's the same term I said to them, so I'm not speaking out of school. But I mean, this is what they do,
And they would be licensing the rights to that IP?
They're actually probably going to be a co-applicant with me on the next round of IP.
Okay.
So they're interested in knowing, I went to them and said, "Hey, we're going to have some IP. Are you interested in sharing in that IP? And if so, I'm looking for money."
Yeah.
Clear.
Boy, I don't know. I'm going to look to Susan as probably much more experience. What would you do in a situation like that in terms of
How do I
figuring
know?
out the valuation of it?
I said $500,000.
Yeah,
because
we're
I
partnered
decided
with Carta, so Carta, that's
Okay.
the cap table, you
Yeah,
probably use Carta.
Yeah.
So you can use Carta for free, and for an expense, you can have a 409A valuation done, so I would recommend, starting with Carta, and I always say, use all your free resources first. Take advantage of the brain trust that we have here with Emily's patent experience, or obviously Karen West, Talbot.
Right.
So it's a very unique question that you're asking.
It
How
could
you
be-
value?
I mean, it could be worth a
It
great
could
deal
somewhat
of
be
money.
Yeah.
dictated by the partner in the IP project as well.
Yeah.
So
And if there's any kind of place where you could bring a revenue stream back to you as a result of that, then you could have maybe a lower in, but there's a guarantee or some type of thing. Those are some things you could probably build into it. That just comes to mind. I would also, I think when you do valuations, if you can triangulate or whatever it is, a number of different approaches to try to say, well, they're all kind of coming in around the same place, and you kind of get to a sense of that. I'd also go and do, just a competitive patent search just to find the keywords and the like. And I'll tell you, I've been up on the USPTO a lot of hours in my life, and the Google system, the Google patent search is far superior in terms of friendliness. But you can put in search terms and just see what else is out there, find out what those companies are doing, find out what those companies are valued at. You might at least be able to get some equivalents on it. So that might be some fun.
Thank you.
Yeah. All right. Okay, so I haven't even gotten to what I'm supposed to talk about. All right, here we go. So what is due diligence? It's just simply a process where you have talked to us enough to let us know what you're doing. We're intrigued enough to go to that next step. So it's a little bit like a dance. We're maybe at least going out on a first date. The due diligence would be then maybe that second date. Or maybe leaving a little deeper. So what it is really that chance to really learn about your business and to find out if there's a good match. It's accomplished through a deep engagement with your business, not as deep as what venture capitalists do, but it's still relatively deep. And I think really importantly, that third point is it provides an opportunity for founders and investors to get to know each other and decide whether or not it's a good relationship, right? Because you don't want, you don't want a dickhead in your business, it's okay. That's I was going to go, yeah. You don't want somebody who you're not going to see as someone who's on the same side. It doesn't mean you can't have disagreements, but it has to be someone who's like rooting you on and moving you forward in a positive way versus like, oh, I just took an adversary on in my business. There's enough other challenges that you have. And so just because there's money that comes along with it, it's not enough. Find people that believe in what you're doing and are investing for the right reasons. I would strongly push that. Due diligence in this process, if you think about it, most times when you come in front of an investor, whether it's an individual investor or if it's a group of investors like Maine Angels, you're going through some process where that group is narrowing the field of who they might want to invest in. And so for Maine Angels, there's a screening process. You can go onto our website. It gives you exactly what you need to do. You can apply. We'll get that. We then choose on a monthly basis a couple, sometimes 3, but generally 2 companies to pitch. And if we have member interest, then that deal would move into due diligence. And that's what we're going to talk a little bit more about. And then there's this kind of moving out of that courtship into a road of investment, which is usually finalizing the investment the terms and the like, and then the ultimate investment. So I'm dating myself. I don't know, there's a group called Blue Oyster Cult who does a song called Don't Feel Good. Don't fear the reaper and don't fear due diligence. Due diligence is a process, and I can tell you from what I've already heard and seen, you're getting the right education to be able to manage it and to be very proud of your ability to just absolutely ace it. So it's that chance for you to sit down with somebody and have that discussion about your business. And I think one of the most important things is that Maine Angels is an example. As I said, I don't have any intellectual property knowledge except having learned from my colleagues, but we do have lawyers. We have people who are at University of Maine who used to be heavily involved with the patenting of things. So we have people that are very knowledgeable about that. We have people that are crack financial people. We have people that are unbelievably good at SaaS model programming and data technology. We have people that are supply chain experts. We have people that are marketers and the like. The people that generally become interested in the business and are going to be the due diligence team are the people that are experts. And so what you get a chance to do is have the tires kicked on your idea. And while that sound very threatening, at the same time, you can walk away from that process going, you know what, I need to really think through that component. There were a lot of questions about that. So let me think through that part of my business better. And so when you go and you apply for the grant, or you go and you're going to go back, you refine your pitch deck, you're going to get tighter and tighter and tighter on what it is that you're creating. So I really do think it can be extremely valuable time. And also, most angels want to be not deep into your knickers on your business, but they want to be there to support you. So example of a company that Maine-based that's moving from having done contract manufacturing to thinking about doing their own manufacturing in the food products industry. They called me because I've been the deal lead. I've been in touch with them a lot and said, hey, do you know anybody who might be able to help us, learn a little bit more about what are the options and what the costs are to be. Where do I put this thing within the state? What are the things that are available? We got them connections into DECD. We got connections into small business. We put them in touch with people that had a very successful food business that had been contract manufacturing and wanted to and now wanted to be in state. One of their people that's now working for the state, who was involved with all the licensing and permitting, is now working with these guys. So we have connections. And again, back to 3 connections, we can bring people together. Not that we're going to have all the answers, but we can be that person who can kind of help make the connections and feed things through. So what does it consist of? It's basically, once you've pitched, which is generally how we do it, we are individual investors within Maine Angels. We don't invest as a group. Every person makes a decision as to whether they're going to invest. We find out if there's interest. If there's interest, then we say, okay, let's get together this team. We put together a due diligence team, which may not be everybody who's interested in the deal, but it's a group of 3 to 5 or 6 people that will kind of move and shepherd the deal through the process. And the first thing we do is we say, okay, everybody who's interested in the deal, and even those of you who are not, what are all the questions that you want to know? You heard a pitch deck, you heard a pitch, it was 15 minutes. We asked a few questions afterwards. What are the outstanding questions? What are the things that you liked about the what you heard? What are the places where you have concerns or questions? And we put all of those questions together and we arrange them in such a way that we can then feed it back to the founders, to you guys, to say, okay, on our meeting on Tuesday, here's the questions that we'd like to go through. And we organize them, and I'll talk about that in a moment. We generally try to do face-to-face, but we do also do Zoom. We like to do face-to-face if there's something that we need to see, feel, and touch. And some of those things you don't need to see, feel, or touch software. But if it's a manufacturing facility, if it's something where you've got a prototype that we really want to kind of look at and see, then we'll suggest a time either can meet where we are, or generally we would come to where you are. Once we've done that face-to-face meeting and had that discussion, and we get a chance to know you a little bit better, you get to know us a little bit better, we then would probably have follow-up and the like. We will then go out if we need to and check with other people to say, okay, hey, we need to get somebody who really understands supply chain that's coming from Zimbabwe, right? Because that's where this particular resource that you're using is coming from Zimbabwe. We don't have anybody who has that knowledge. Let's find somebody who has that, who's doing importing of a particular ingredient from Zimbabwe. So we would want to find out, because maybe that was a choke point that we saw about reliability of that coming. We'll do the kick the tires. We'll have conversations. We'll ask for you to tell us if you have other investors, whether we can talk to them about why did they invest and where they're at with it. If you have customers, we may want to go out to one or two of them and talk to them a little bit. If it's the kind of thing where you don't, that creates challenges for whatever reason, we'll try to figure out other ways around it. And what we'll ultimately do is develop a due diligence report, which is a report that goes out to our members that are interested, that says, here's what we found. And I'm going to talk about those in a little bit. And the decisions made to invest and at what level off of that. And that process, from the time that you pitch to the time that that's done, is generally not less than 30 days to point of decision of investment. And we try to keep it under 60. So it's not turnaround overnight, but it's not horrible. I would say for you, there's going to be one of the things that we'll do is we're going to get a bunch of questions to you beforehand, and we'll also ask for you to provide us some information. The good news with going through something like Dirigo Labs is this is not going to be things like, I don't know what a balance sheet is, or I don't know how to put together a pitch deck. These are all things that you're going to know, but we're going to want an executive summary of what it is that you're doing and why this particular product or service is going to solve something that is of importance. And then we'll get the key questions to you. We're also going to want a fair amount of financials, P&L, cash flow, balance sheet are the big three. And obviously if you're pre-revenue, some of those things aren't going to make a lot of difference, but we want to at least see what you're forecasting. What are you going to do with the money that you're asking for us to give us? If you're in a place where you're either just about to begin selling or you already are selling, we want to see the sales pipeline. And part of that is because we've seen that one of the places where a lot of startups fail is not in the development of the product or the marketing or anything like that. It's when they start to go into the market. There's been a mentality that they think, if I just get this out to the market, everyone's going to run to my door. And unfortunately, it doesn't happen often. So one of the things that we try to push for these days, and it's one of the things that we're providing guidance on, is what's your pipeline look like? And where are you going to go and how are you going to go to find those people that you think are going to be marked targets for your product? A cap table, which is, I know all of our cap tables, right? It's going to probably be pretty simple, but we want to just kind of like, who owns your business? And if you have deal terms already, and this is about lead investors, often we'll create the cap table, negotiate with you. The lead investor actually says, here's what I would be willing to do. And then we'll negotiate. If that's already been developed, then we want to see where you're at on deal terms. And then we might look, and we'd also ask you, should say third party industry, if you have research that supports what you did, not the kind of thing you can give us in a pitch deck, but now we really want it. Hit us with it. All that stuff you can give us is very helpful.
At that point, are you signing NDAs?
We don't sign NDAs. And I know that sounds like but the reality is we have 300 people apply to us, 300 companies apply to us every year easily. We hear pitches from 20. And even you're going to see in a moment, I picked 3 kind of random companies just to talk through, and I'm realizing there's some overlaps with some of the companies that are here. It's just too hard, and so we will commit to confidentiality, and there are places where we can make sure that the confidentiality is kept to a very tight group, but we can't do NDAs. Can't do it. Once we invest, then all the information that you provide to us, quarterly reports, hopefully, we make sure that all of that is kept very confidential. How am I on time?
You're fine.
Okay. Well, that's the reason I asked. So when we look at, and everybody does this a little bit different, but we have 11 areas that we dig into. And they're going to always vary from company to company as to which areas get the most. But these are the 11: the management team, the technology or product, the product development plan, which is not only here's what I've got, this is great, but that's awesome. That'll get you off the ground. Where's it go after this? Is it an expansion process, or is it going to have this new thing that's going to happen on it? We want to understand that because, again, we're making a long-term investment. We want to make sure that there is the ability for you to scale and to move your business up so that hopefully we can get a return. We want to know about the market from a big picture, like what is the market, what are the trends and the like, but we also want to know what's your go-to-market plan, which is your marketing and sales strategy. And then those next 3, revenue, financial, and funding, obviously are all around the money. Governance is really important to us, and that's one I'll talk about a little bit. And then syndication, the deal terms. If you have deal terms, that's great. If it's being syndicated to us, which maybe for Maine companies wouldn't be as likely, we'd more likely be syndicating you elsewhere. We want to talk about that. And then importantly, and sometimes you go, well, exits, that's way off in the distance, but we want to know that there's somebody who'd be interested in buying you, that you're going to go and be an IPO, which is rare, or that there's some other mechanism by which we would get our money back. And we'll talk about that a little bit, because it's one of the things that probably is one of the most challenging things for folks. So really quickly, I'm just going to go through these, and I'm not going to go through all the details, but I want to just talk about, when we talk about management teams, probably one of the most important areas we focus on. Why? Because without the people running it, you guys and your team, if you're not a solo entrepreneur, that's really, really important, because if you all walk away from the business, there's really nothing left. So what are we looking for? We're looking for expertise. We're looking for passion in what you're doing, and we're looking for commitment. So back to that kind of idea, if you put some skin in the game, either over time and or money, that's a way of showing that commitment. We want to look at things like, I'll leave it at that. There's a bunch of details on that, but it really gets down to expertise, passion, and commitment. That's what we're looking for in that. We want to make sure if there's 3 of you that are partners, that you work well together. And we want to make sure you're not all, if it's a SaaS model company, that you're not all data programmers. We hope one of you is, but you shouldn't all 3 be. And we want to make sure there's a clarity of what the roles are and the like. And we also want you to be telling us where there's a gap that you might be wanting to fill. Maybe that's one of the source of funds, is that you're going to get a chief marketing officer or something like that. On the technology or product, we want to make sure that it believably solves a problem that's out there in a differentiated way, right? It's got to be something that has a level of uniqueness or differentiation from the other things that are out there. You're already behind whatever else is already out there, because they've already got a name, they already have a brand, they've already got funding and the like. So it has to be something that has something that is differentiated and that can be leveraged in order to make it happen. So we were going to look at things like, well, how well does it work? What else is out there that you're aware of in terms of your competition? If you have IP, what is the source of the IP? What's the strength of the IP? And have you done things like freedom to operate, which is there anybody else out there if you've got a provisional patent that you could possibly be infringing on? So that's so we always think of IP as being offensive, right? Like, I've got IP. It's like, yeah, what you're talking about here, it appears that this patent would already cover that, and you're probably not going to get your patent because that's freedom to operate. So we want to make sure that there aren't any of those kind of barriers if you're in the process of getting intellectual property. The product development plan is, we just want to make sure there is a plan and that you're anticipating the future and you know how you're going to grow it. It may be that the thing that you have is so good that you don't see that you're going to need to have either brand expansion or some other type of way of migrating that product, because it's like such a gem right off the bat. You're not going to need to do anything, but you're going to have to convince us that that's the case, right? Because we have to see, how are you going to grow that? How are you going to scale your business? And by the way, that could be things like geographical expansion. It doesn't have to be a product proliferation or brand expansion. On the market, we want to see what you see as the market that you're competing in, and what's the accessibility of that validated target. So how easy, for example, you've got a target audience, you bulleted it, you've got the on the target, you've got the bullet, the thing right at the center, the bullseye. Thank you. So you've got a bullseye target, then you have your probably secondary target and maybe your tertiary target, maybe. What's the bullseye and how easy is it for you to get to those people? Because you can have a great product, but if you can't get to that person, if you have to be at a CEO level, if you have to get to the purchasing agent of the Department of Defense in a deep area that has a lot of security, those are going to be hard places to try to get to. So we have to see if you've got the plan of how to get there. And it may be you have those relationships and the like, which might be great, but we'll really want to understand that. And then on the go-to-market plan, we want to make sure that your way, and some of the things I was talking about in market is also goes into go-to-market. We want to make sure you have an attack plan that's logical and that's going to be effective. And again, this is one of the places that we're seeing a lot of weakness sometimes when companies come through. So a strong plan of how you're going to go to market is really important. It's very, very expensive to try to do, go to all markets simultaneously. So priority is going to be really important on this. As far as the revenue, it's all about the execution of the sales plan, and the resulting revenue is believable. That this sounds like it can make sense, and that you're not being over optimistic. There's always going to be optimism built into almost every plan. We recognize that. Over optimism is somewhat of a real turnoff for us, because it means that the realistic sense is not there. On the financials and the projections, so this is more than revenue. Now we're talking about all your projections, costs of goods, what your overhead's going to be. All of that needs to be realistic and it needs to be thought out. If there's a lot of gaps in saying, well, where are you going to be doing this? Oh, we're going to have a manufacturing facility. It's going to be, well, where's the money for the plant and equipment? Oh, we didn't have that in here. Those are the kinds of things that we would, guide you and say, you know what, maybe not quite ready yet, but may want to think about that. From a funding standpoint, we want to understand, where you are in your capitalization, what you need is appropriate, and that the sources that you've got are going to be adequate. Generally, when there's a raise done, the raise doesn't close until you hit a certain threshold. We need to understand what that threshold is so that we can say, yeah, we would commit this amount of money towards that, but we're not able to fill the whole round. And that's when we can get into things like syndication and the like. Governance, really, really important. And sometimes it's something you haven't fully thought, although I heard somebody saying about board members. So that's really good. Governance is one of the things that often is not fully thought through for smaller companies. And it's really important. Why? Because governance guides how things happen, good and bad. And when bad things happen, we want to understand that there's a way of going through the process of either unwinding something, unraveling something. But more important, we really want to make sure that you have people around you that are guiding you. And if in the management team, there's a gap in expertise, that you're getting that expertise from other people that might be people you'd have on your board or board of advisors. And there's the legal structure of a board, and then there's a board of advisors, which is not legal. It's something you can do as well, but they're both really important. And we want to see, this is an indication of how realistic is the entrepreneur in understanding where their weaknesses are and how are they managing for that. So it doesn't mean you have to have a full board, and we're not talking about, but in your documents, in your investment docs, you're going to have some type of, if you're working with a lawyer at all, you're going to be working with they will have a section that talks about how is this organization, this company, how is it, what is the oversight on it? And what we want to do is see what that looks like. If the investment is significant enough, meaning that we're a significant portion of your cap table, we may ask for a board seat. Or if not, it may be a board observer, which is an observer is just somebody who can watch, can give advice, but doesn't have that right to vote. But those are the kinds of things that we want to see. And the more you've thought about it, it's also an indication of the sophistication of where you are in your development of your company. So the syndication and deal terms is really, if you've got deal terms, again, it may be that you already have a lead investor. It may be that you come without deal terms. That does tend to lengthen the process. We like when people come to us with deal terms. This is everything from valuation to the deal structure. What are our rights, like investor rights, like board observers, or there's different things that we look for, including the ability to have pro rata rights on further investments so that we get the chance to come back in. And if we owned 0.1% of your company, we get the right to put money in at the new valuation that would allow us to maintain our 0.1%. So those are some of the things that we look for. And then, of course, the deal structure. What's the minimum investment, your min-max raise? I can tell you that, and also an important one that I forgot about is the Maine seed capital tax credit. You probably are aware of that, but if you're a Maine-based company, or if you have significant boots on the ground in Maine, Maine has a phenomenal program called the Maine Seed Capital Tax Credit, which allows us to take a tax credit against our own personal taxes, which makes our risk much less. And therefore, we're A, generally able to invest more, and B, we're more more likely to invest. So I would suggest Maine Seed Capital Tax Credits are one of the things that come up a lot for our members. It's a very valuable thing. It's an application you make through the Finance Authority of Maine. If you go up to FAME, they have all the information there.
We've done it. It's not bad. We've done it.
Yeah, it's not that bad, right? That's what most people tell us, and it's not arduous in terms of what they're asking you for, right?
No, it's stuff that you would put together for this anyway.
Right.
So it's actually a good policy for it.
Right.
Is it like a tax exempt approval?
Once they approve it, you've been approved, and what happens is it's a very simple process. You say to us, yeah, we're Maine Seed Capital Tax Credit approved. There is one, and we generally get all the papers together at the same time, and you have to kind of say, yeah, these people are investing in my company at these levels. That's it. And then we do all the rest of it. We send it up to FAME, and yeah, it's actually very, very streamlined, amazingly.
We do cover that too, guys, next week.
Okay, sorry. So ahead of
We're
the,
off next week.
so now you're all gonna
Next
be,
week, we'll have under the state incentives, we will have a representative from Maine speak on Main Street capital tax credit.
awesome. That's great. Yeah, fame is phenomenal.
Hey, Ryan, I'm Dave Shoemaker, I'm a mentor with you a year ago.
Hey, Dave. Thank
So it
you.
looks like your portfolio has a number of biotech companies. So where is the due diligence for the FDA regulatory component done in this model? Is it in the product development plan, and do you have FDA expert on your in your program?
We do. We actually have a number of people that are in pharma, in both research and in actual development. So yeah, the FDA generally, often we're investing before FDA, but we want to look and see if there's anything that would be a blockage on that. But we would do it as part of our due diligence, and there's a couple of people we will call in on deals like that.
I'd like to talk to you some more.
Yeah, absolutely. Yeah. And the other thing that I was just going to say was that people go, well, how much do you guys invest? As groups, we tend to invest anywhere. We've invested as little as, generally we need to have, for us to call it a Maine Angel portfolio deal, because there's work kind of tracking and the like, we like to have a minimum of 3 investors. That's not to say we haven't had companies who have come and one person says, well, I really want to invest. We had one of those not long ago, and that's fine. But then we kind of not put it onto our portfolio, just to kind of, it's almost like our own cap table. We want to kind of keep it, because we push very hard to make sure we're getting quarterly reports and the like. And that's one of the things that we do, is reach out on behalf of our members. But generally, there's usually 5 or more Maine Angels. A low level would be 70,000, 50 to 70,000, and we've gone as high as $1 million for, as a matter of fact, one of the biotechs. So, but most things probably run in the 120 to 250,000 would be about kind of where we do it. Once they're syndicated, it becomes a larger amount. From an individual standpoint, we urge invest. You guys set what is our minimum investment, but we urge founders to set a minimum of $10,000 if possible, because we have a lot of people who like to invest at the $10,000 level, especially new members, because one of the things we push for is diversification of your portfolio. So if they've said, okay, I'm going to spend this much money in the first year or something, they don't want to put it all into one basket. We have people who invested at very wide ranges, and but generally people are investing between $10,000 and $75,000 per investment. Yeah, I think that's probably it on that. And I realize I'm blabbing a lot. The last thing is exit, and it's the last thing you're probably thinking about now, but thinking through who would be the likely acquirers of your company is an extremely important thing to do. Now, when I say acquirers, and why do I focus on that? Because you might be saying, oh, I'm going to do an IPO, I'm going to be the next Amazon. That's great. And that does happen. It doesn't happen a lot around here. Generally it's going to be an acquisition by somebody who wants what you do to add to their portfolio, who sees the ability to take it and move it along. So that's why we usually look at that as an exit. And what we started to say is it's an exit. Think of it as, and maybe it's an exit for us, as less for you. So Pika Energy, company from Maine, was acquired by Generac. They made wind turbines originally, and then they made very intelligent interfaces for alternative energy into the grid and the management system. So Pika was a portfolio company of ours. They were acquired by Generac. So that's an example of where an exit event was occurred. The founders of that stayed on and now are running Generac's alternative energy division as the president of that division. So it doesn't mean that it's the end of the road for you, but we would just need to have a way of extricating our money, because this is different than a loan, right? Where a loan you're paying back on a regular basis. This is equity, which means if you don't have an equity event, we don't have an equity event generally. So it can be something else. One of the things that we'll look for in an exit is there's a term that's a kind of a pejorative term. If we say to you, it seems like you're making this into a lifestyle business, that's not a compliment. Because what that means is you're doing pretty well. You're making, I don't know, 130 a year. You know, you could probably be making more out on the regular market. Things are going pretty well. Business is going up a little bit every year, and we're going, we need to get our money out. We need to get our money back because we want to invest in other things, right? And you're going, yeah, but this is working fine for me. You know, why would I mess this thing up? That's when we have a problem. So think about exit and think about in your own mind, because if that's where you want to be, if you're thinking about this is a business that I see being in for 20 years, then angel investing is probably not the right place to go, because the reality is, if you look at an investor, and I know it's hard to say, like, well, yeah, they gave me $10,000 and I'm going to give them back $70,000. Well, if you do it in 12 years, it's not a very good return in reality for the kind of risk that we took on. And for the fact that during that 12 years, we didn't have the ability to take that money and go and say, ooh, I'm going to get it out of Microsoft. I'm going to go move it to Amazon, or I'm going to bring it into General Motors. Do they have a really cool new EV car? I think it's going to do great. We don't have that ability to flex with it. So it's one of those things that I know it can get sensitive, but think through that part of it. There's a company we have in our portfolio that has not exited, but they're at that place now where the profits are good enough that they're starting to pay dividends to the shareholders, and the shareholders are very happy with that. And they created an event that said, if you'd like to sell your shares, we have 3 shareholders that are willing to take your shares at this, and a couple people opted for that. So there's different ways to play it. Doesn't mean you have to leave your company behind, but you need to think through the exits. And what we want to see at this point is, do you have a plan for who might be interested in your business? And looking us straight in the eye, are you willing to go through that process of allowing us to extricate ourselves from the business? The angel world is one where we want to help you. We want to help you get to a place where you're successful. And then we want to go, this has been awesome. We'll stay in touch. We'll take our money. We'll come back over here. And we want to help somebody else who's doing the same thing. That's where our juices get flowing, right? And a lot of us work with a certain amount of money. It's not like we have it, just like, oh, we'll just take another, It's like sometimes we have spouses who say, this is your money to play with. And so what we want to do is make sure that we can help as many people and grow the economy. Most of us have a passion for Maine, and we want to make sure that we can help as many people as possible. Okay, I think that's it. A couple last things. Due diligence report, just kind of going back, all of that feeds into the due diligence report. This is the thing that goes out to our members. It has a company overview. It has an objective summary. And what we love to do is what we refer to as what needs to be believed in order to invest. The WNTBB, right? What is it that needs to be believed in order to invest? And then each individual investor, each member can decide whether or not we meet that. So then we do the key findings usually by that same due diligence components I just showed. And we'll sometimes do a ratings reco, and sometimes we don't. Sometimes we just do neutral, but we'll say we have an investment bias, a non-invest bias, or neutral. We have a couple different models. Each deal team decides on what they want to use. Some use a numeric kind of system and the like. So just a recap of what we look for. I think I've hopefully said all of this stuff, but just, we're looking for innovative, differentiated products or services that have proof of concept. And that doesn't mean that you have to have revenue, but we want to see that you've got it to a place, prototype it and the like. We want your skin in the game as a committed management team. Scalable. I think I heard Mark say 2 to 5 or 2 to 4x or something like that. We say 3 to 10x return over 3 to 7 years is kind of what we're looking for, which is probably more generous than a lot of angel groups. We're looking for appropriate deal teams, realistic valuation. We want to make sure we're aligned on that. And your financials have to be based off of your facts as you see them, and that it's realistic. So the most recent 2 major reasons for decline. One is the founder's just not ready for outside investment. that's when people come to us and they just haven't thought through some of the things that we've just been talking about. I'll let you read that. But these are all the things that I think, Dirigo Labs is working you through. So this is much less likely to happen to you. And a couple of those things are like, you're looking for a passive investor. You don't really want input. You will not be getting calls from us on a weekly basis. It's the kind of thing that we hope to get a quarterly report from you. And we hope that you'll reach out to us if you need help in an area. Because we have a very wide member base and we have people that have expertise and connections, kind of all around the state. But if you're not interested in exiting or buying out an investment, which is another way to do it, you buy out the investor in 3 to 7 years, then probably angel investing and equity investing may not be the right place for you. The other area is that the business isn't really scalable or growth oriented. In order to get that kind of return, there has to be a certain kind of business. And it's the kind of businesses I think you're building. They're businesses that once you're able to get to that place of getting some traction, you have that ability to scale it. And you have a plan for how you're going to do that. So you're going to get some pretty dramatic growth. So, most one location retail stores are generally not differentiated and they're not really scalable in that way. Many small businesses invest in, by the way, I love small businesses. I've actually invested on a different thing on small businesses that I don't expect to get my money out in the same way, but that's not angel investing. And single app technology, we tend to look for things that are platform because again, scalability on an app is really hard to do to get to that level that you want to get to. So I was going to run through these real quick.
Yeah, we have to allow time for Q&A.
Yep.
Maybe 5 minutes.
Yeah, no more than. Sorry, I get very talkative. So 3 examples of 3 companies and kind of where we got to. It's just Susan thought that might be a good idea to give you guys some ideas. So this was a company that was making computer-based self-management support for individuals with chronic diseases. Think of a home system that would be in the home, simple to use, primarily for elderly, to avoid costly hospitalizations and live more fulfilling lives. And what we decided on this one was there were a couple things. This company had been at it for a long time. They actually came back to us 3 times. Ultimately, there wasn't an investment. There was not an investment. And what we had to ask each time was their product superior, where they had a bit of a jump ahead of competition at the beginning, and they were unique. Over time, that had kind of dissolved. Could they make it work? And was it the right management team to do this? The CEO was very adamant about staying in that position, and we just felt that probably wasn't the right leader for that particular one. So that's the things that we came up with, the what needs to be believed. You can kind of see those were the things that for actually all the people that looked at the deal, they made a decision that those things could not be believed in order to invest. Second one was, and this is a very different kind of business and probably in some ways not an angel kind of business in some ways, but this was a company that wanted to use mothball paper mill facilities to produce green building insulation products and to use wood fiber instead of alternatives. And it wasn't that they had a unique product here. What was unique about their approach was taking a European technology and bringing it to Maine, where we had an excess of the raw material, the fiber, wood chips and pulp, and also the fact that we had some boarded up paper mills that were sitting there. So what we saw as being the what needs to be believed is that they could generate the market interest via their distributors, and that they were going to have this lab which was going to be able to show people how the things work, that the insulation market would purchase non-fiberglass types of insulation, that we wouldn't be completely overwhelmed on something that was going to be tens of millions of dollars of investment, because we were a relatively small investor on it, and that the management team could build a manufacturing facility first time out. There was seasoned, experienced people there, and that there would be interested acquirers. And this is one that we did invest in.
We're happy about that.
And we probably all know who it is. Okay. And third one was a technology platform that boosts college enrollment by increasing students' commitment to college. It did it in a way that was different than like a Facebook or the like, but there was a social media that basically you signed up for it. It was a closed system. You signed up, you indicated what you were interested in, you connected students like them, they could then make that connection. And the key thing here was getting kids to actually go to college. And this was extremely important for a couple of groups. People that were out of state kids who were going to be going further from home than they had probably planned or expected, but they got into a good college that was out of state, or first generation kids going to college where like all their friends are staying home going, why are you going off to college? You're going to miss all the fun, now that we're out of high school and the like. And what needed to be believed was that this reality that there's a shrinking base of college students was going to make it that the colleges were going to be wanting to find, so there's what they call summer melt, where kids sign up, yeah, I'm going to school in the fall, and then over the summer they decide not to. And and for the elite schools, this is not a problem, because if you're at Harvard, you just go, okay, who's the next one on the wait list? Yeah, they can come now. But for the middle and the lower tiers of colleges, that was a room that was left empty. And if you think about a college, there is no, I can't think of any business where the value, the variable cost of an incremental student is so low, right? So if you have 1,000 students and you take that 1,000th and first student, the cost to the college is nominal for that, right? You're not adding a lot of professors. You just have one more kid in the class. You've got a dorm room already. So they were losing this highly profitable margin when these kids wouldn't show up. So that was the key thing, was that was going to be that trend, that market trend was in fact a reality. And that the technology was good enough and the platform was good enough that it would do what they said. And we did a lot of work on it. We went out to a lot of college kids and had them try it and the like. That the competitive alternatives for reducing no-shows wasn't sufficient, and it wasn't going to solve it. And that they could scale rapidly, because our thing was like, well, this is going to take off. So how are you going to be able to scale? So we were a nice problem to have, but still critically important. And that there were enough exit opportunities. And this is one where we did invest. This is a company we did invest, because we looked through that, and most people who had looked at the deal, and it's one we actually ended up syndicating, and there were investments from Boston, New York, and Rhode Island. So, okay, I think that's it. Yes, I got to it. Your outstanding questions. Sorry, I get really into this, and then I keep talking.
Great. Bring your question.
Thanks.
Let's hear going back to talking a little bit about projections. We've been having lots of discussions about transitioning our revenue to a subscription-based model. It's always been through advertising. And we've been also looking during this period to acquire some financing. And so we've been wanting to learn more about how to create a projection on our possible subscription model without having any actual validated data of like, hey, we brought on 10,000 subscribers this year.
Have you done any pricing kind of exploration with your existing, like what they'd be willing to pay for the
I just started this kind of process a little bit with just a very vague customer discovery with just a small pool of riders. Yeah. I'm a snowmobile business, so I have a little pool of riders that I always chat with. So I ran it by them, but yeah, I wanted some ideas or examples of what people have done in the past to kind of paint that picture. Something and we're also seasonal, which makes it tough. So yeah, I was just wondering if there's anything we could do kind of during this period to gather some of that information.
Yeah, I mean, the first thing I would do is try to figure out whether that model is going to work. And because snowmobiles are so kind of club oriented, it seems to me that if you went out to a couple of spots, do one in Cumberland or Oxford, do one mid-state, and just say, there seems to be a lot of interest here. You might even find out the model is sell it to the club, because they're going to have, and they'll just take it as part of their membership. It's a benefit for getting the maps and the like. But you would get a little bit more information about it. Once you've got that information validated, then you can do your extrapolation to say, we think let's just say you found that the average club has 80 members. I don't know. That's probably high.
Yeah, a little high.
Something a little high.
Nowadays.
It's a big club.
Nowadays, yeah, big club.
It's a big clubhouse too. That they have, 40 members on average. We think we could get 20% of those. There are this many clubs in Maine, if you're going to stay just in Maine, or, if you add in, the other states, that could be part of your expansion thing. That starts to give you a model then of what that might be. And because you'd be pre-revenue on that, if you've been able to show that you've been able to
The advertising.
so the ad model. So this is the classic pivot, right? You are doing that pivot from being something that's an ad revenue based to that new model. So that's good news because you already have an existing business. You've done well with it. You see the revenue opportunity, I'm assuming, profit, maybe hassles on your part for selling advertising, pain in the ass. All of those things you can start to say to an investor, we did it this way, we're making this pivot, and here's where we see what the monetary difference would be.
Okay.
But you should be able to at least get to a revenue number that way, at least, and keep it as real as possible.
Okay.
And conservative.
We've also been, we're a software business. We do have viewers.
Mm-hmm.
They get to access the site for free. We've thought about integrating some of that, statistic of like, here are our monthly averages on our free viewers. We could,
Start to see.
Yeah, a percentage of that,
You're not the first software company that's gone through that transition. I'm just trying to think if I know of anybody who's gone through that, because they could probably say, okay, we had this kind of attrition with our free users. Even in Kenny, we did. I mean, he was doing free, and then didn't he move to a paid model?
No, but that's a really good recommendation.
But it might be something just to talk to Michael about. I don't know.
Was it a rude thing? The French speaking that?
He did a language app.
Yeah,
language app.
Vaguely hearing.
Yeah, but then I would think there's research out there that's kind of goes, when you move from a free revenue, advertising model to a subscription, this is the kind of fall off you get and the like. But and then you have to bring in your business, right? Snowmobilers are phenomenally passionate about the sport, about the camaraderie and all of those other things. So you kind of bring that part of it in, and people are probably going to be willing to pay a certain amount if your mapping is as good as I'm sure it is.
Yeah.
Okay. So, yeah.
Yeah, no, it just, as we wanted to have more conversations with, MTI and some other brands, and, not worried, but just wanted to really make sure that picture is painted accurately. So that we're not.
It's one of the things that probably, like on something like that, there's a number of people that we have that are kind of SaaS model experts, and probably go, hey, what do you think about this projection? And it's always great when somebody comes back and says, that's pretty realistic. I think that's probably what would happen given what his base is in the free model. And then I really do think going out to people and saying, what would you be willing to pay for this? And get some of that, so you get some realistic stuff, get some. If you did it online or something, you could even get some quotes on it about, what would you say about something like this? And it could be the kind of thing of you just going and visiting, like season's almost over, but like on a Saturday going to one of the warming huts or something like that. And just kind of talking through it.
Okay.
And getting qualitative data is fine. It doesn't have to be totally quantifiable, but I think, as you move to quantifiable data, then it's all the better, but this is the kind of thing it's going to be qualitative anyway. So, yeah. Yes.
We're not seeking funding. Do you guys offer consulting services as well?
Yeah, I mean, like what I said, and I've got cards and stuff like that. What my comment about, make the relationships before you need the funding, I would strongly suggest it. Yeah, I think, but we don't. The answer is no, from a standpoint of we don't have like a revenue model. Can I join Dirigo? I want to build the business, right?
Yeah.
We don't have a business of consulting, but we also have people that are pretty generous with their time. Most people are wanting to kind of help stimulate the economy. We want to keep young people. A lot of us are getting older. We want to keep young people here, that kind of stuff. So yeah, get in touch. I'll give you my card.
Yeah. I was interested in the point you were making about a company that's not investable because maybe the founders wanted paid back in 3 to 5 years, which would normally happen on like a, sorry, what I mean by that is if they took out a convertible note,
Mhm.
they wanted to pay investors back, that's not as attractive to Maine Angels because you're not really getting much interest. Is that what?
On a convertible?
That was the bullet point, the final bullet point in your slide about when we probably wouldn't do that.
Oh.
I saw something about 3 to 7 years.
Yeah, 3 to 7 years. Yeah, if there's not a way that we can see having some type of revenue coming back to us in that time, then it's probably not. It's probably something we would not do.
Okay, so for entrepreneurs that might want, I think the question that we've been wrestling with is, I think we'll be able to continue driving revenue, but there will be times where, like I was saying earlier, it'll get a little thin and we need to get through that period. So we've taken a line of credit, which is, I think, good, but we're also tended to use it. One other way to do it is to have like a small round bridge financing that's kind of like your little emergency fund. And if you did that as like, a small convertible note round.
Yeah.
Is that something you guys have done before?
Yeah, sorry, I should have mentioned that. Yeah, we probably do follow-on rounds with at least 40 or 50% of the companies. And CoreStorm is probably a company you guys know. So we've probably done 3 rounds with those guys. And they're one of the companies, I said nobody, we always kind of discount what their revenue numbers are going to be. And those guys are like rock solid. They are so predictable and they always would just come in. They're so solid. So they had this unbelievable, and it's going to take longer than they expected, but because they're looking for, it's going to be multiple years. So it's longer, but they have been so good at doing, their communication is outstanding. We know where things are. We know if there's problems before they happen. The way they negotiated COVID. There's never surprises. It makes us all want to work. Huge fans, right? They're kind of like the poster child of what we say to other companies. If you can be a little bit like CoreStorm in terms of your reporting and stuff. So follow-on rounds, back to your question, is something that we do. And actually we do it at a higher rate than Angel. There's a thing called the ACA, the Angel Capital Association, which is a national group. So we get all these numbers and stuff, and we're significantly higher in terms of the follow-on rounds than we do.
And you say follow-on round, you mean we've already invested in them and now we're going to bridge them.
Right.
What I'm asking about is actually more of a small seed round.
Yeah.
But not because
you would do like a convertible note follow-on round. Yeah.
Okay.
Yeah, they call them follow-on rounds if we've already invested. And often convertible notes are used. That's originally what convertible notes were used for. They're used way too much now, but it's something like, it would be that bridge to a further round or the like, or to some other kind of exit. You can have a convertible note that converts on time, or an event like the next time there's $1 million raise or something, it converts. So there's different ways to do conversion.
Okay. And have you ever had a convertible note? This was the original question I was asking, where the founders negotiate in a payback, like instead of converting, there's also the option to pay back investors at a interest rate.
That's exactly what happened with that one company I was talking about. So
is that Maine Angels, or is that for like
some yes, some no. It depends upon the individual. I mean, if you set it up at the beginning, if you think that's the way you're going to do it, probably less attractive. It's something along the way, and you've been really good about it. Then it's probably a more attractive alternative, which is not to say you should not say it, but really think you're going to do it. But yeah,
for sure.
I mean, if there's a way to get the extrication of the capital back out, and in a timely way,
with a decent interest rate,
yeah, these days convertible notes, it's kind of weird. They haven't really changed much with this weird, because most people are looking at an interest rate that's not going to be for that long. So most are offering like a 8%.
Okay.
And they were down at 5-6. That's the interest rate that's accrued. You don't have to pay it, and then when it converts, that 8% is now part of the investment that you make, and it goes into equity. Yeah.
Question.
Yeah.
When you're looking at risk,
and what the risks are. We found our company in 2017, but the previous administration was not at all interested in renewables.
Mhm.
So now there's, a robust investment in
Yeah.
renewables and grant money. And you're looking at me going, yeah, your performance looks good, diesel is doing what it should be doing. It should be going down, it's because of the war, we don't want that. So I've got my line going down on what we're gonna expect in the future, and I've got a biochar line going up and how we're gonna get to that. But a change in the administration could just totally
Yeah.
devastate renewables.
Yeah, those are things that are outside of your control, and it's hopefully things that in due diligence we would uncover. We'd say, so what are the biggest, issues that are going to be the variables? How would you come off of this projection that you've done? And you'd say, well, a change in administration can dramatically change it. We bring that into the risk.
Yeah. It's like not one of the things I can manage.
Yeah, right, exactly. No, and I think we're pretty realistic about, what's under your control and what's not. And that would be one of the things. And we have, we have some people that are involved in energy sources and the like who could probably, at least validate that, and we would probably look to, that might be one we go to outside sources and just see, not the policy side of things, because governmental policy, who knows, right? But at least in terms of, that seems realistic, and here's how biochar can come up, and this would be the value.
Part of our revenue stream comes from the sale of RINs, renewable identification numbers, which power is called a REC. You know what a REC is? When it's fuel, it's called a RIN, and that's managed by EPA. And it's significant for us to sell those RINs to obligated parties. Obligated parties are refineries that are not meeting their environmental goals and they have to buy them.
Right.
Well, those were suspended last time. So that's a whole line that just went away.
Yeah.
Pre-sale of our carbon credits is more on a global basis, so I feel more comfortable about that.
Yeah.
Than I do some of the other items on the performance.
Yeah, and so with the carbon credits, you still have markets like California that are going to have them, regardless of what the federal does and things like that. Yeah.
And we've registered on the carbon futures platform. So we could be trading relatively soon on there, but I'm not worried about that.
Well, you know what? If I would suggest that you be proactive, I wouldn't do it in my pitch, but when it got into due diligence, I'd be really proactive about it. Like, these are we're probably going to ask you a question of what are the things that could really mess us up? I would be totally straight out with those, because then we would make our decisions and say, yeah, but I believe that this is an important thing to do. And so therefore I'm willing to take that risk that administration change could change that. And I also think there's going to be other alternatives, and, we'd make that. And, you might lose some investment, but you can't control the things, but helping us by just understanding that and being proactive versus somebody coming and going, hey, I did some research, and you know what, back in this time frame, everything was pulled away on it, then we might all go, oh, this is not as stable as we think it is, so I'd be proactive about it and just say, these are some of the, these are some of the risks that are inherent that I'm working with, and this is what we're doing to manage it. We're selling some futures that are going to, or whatever it is. So, yeah.
Brian, I'm still caught up with what you just said about this is something that's an important thing to do. Did you mean that from sort of a moral perspective or an economic perspective?
Important to do in your best interest is what I meant.
Because
important
the more to the business. Yeah.
Yeah, it's the important. If you're talking about important about kind of identifying potential risks and the like and letting us know about it.
I'm trying to figure out where Farm Drop falls into the landscape of sort of that social impact investor group that sees the multiplier effects to support the local food economy and is patient enough about the return without it necessarily being an exit. And so I'm just trying to figure out where we might, or I might inspire Maine Angels or investors like Maine Angels to say exactly what you just said, but with the meaning of you know what, this is going to be a smaller amount of money that invests in
I gotcha.
Something that just really needs to happen.
Yeah, so this is important to do was because of, the movement. I'm sorry, I was thinking of a different important. Yeah, so that's very much of an individual, the individual members, for some of them, they might have a huge passion around, like we have members that are hugely passionate about fostering the aquaculture industry in Maine, and they really are not looking for a return per se. They'd like to get one, but I mean, that's an example where there's passion around it. We have a lot of passion around a lot of different areas. So that's I would say the great thing about coming to Maine Angels is there's some people are going to go, well, I'm not feeling too comfortable about that, and might not, because they might not have that passion, but some members probably will.
And are there oh, sorry.
Go ahead. No.
Are there any systems that you've used as an investor or that Maine Angels has used as an investor to include sort of like social and climate impact in your evaluation of a decision? Or like, there's a social return on investment or a climate return on investment. And I was in 2016, I went to London to do a course on how to report very precisely, like you would an economic and financial report,
right?
The social impact and environmental impact, sort of like, how do we retain our water, our seafood, our land, and our ability to grow food is, how do we invest in that as a resource that comes back to us in the form of being able to continue to eat, right? Whereas it becomes difficult, as you know, and Maine Angels, I'm sure, is invested in food businesses. And I heard from some of your fellow angels that it's like, ooh, not always an economic return, but can we change the story of how we talk about return? And maybe this is a bigger conversation, but sorry, everybody.
Yeah, no, I think this is one where you have the opportunity to educate us on that. I mean, I think you have people that would be open to that discussion and open to the concept. I would say that most of what we have right now is qualified, or not quantified, but qualified kinds of, and this is going to have a benefit. If we grow kelp, we not only make a food source that's very healthy, but it also helps clean the oceans, right? That's kind of the qualitative statement on it. If you have things from your London experience to say, here's a quantifiable way to say what this value is, yeah, I would think that would be, I would think we would, I mean, one of the reasons a lot of us do this is we love learning about things that we didn't otherwise know. So I would think that would be something, I would make a page in the pitch deck that talks about that quantification of that value, because it is a value that is not going to mean, for some people, it's not going to be seen in the value of that you're probably seeing it as, but for some people, it's very much going to have a monetary value to it. Yeah. So I think if there's a way of having that quantified or monetized, or an equivalent monetization, yeah, I would include that.
I see it as a categorization, as a categorization of the kind of business that is actually helping to propel other investable businesses, right?
Yeah. Yeah.
Like every 200 farmers or food businesses that are, operating in Maine, and if Farm Drop were to prove itself, as the lifeline to these businesses being able to retain their, prime customer base in this wonderful and amazing way that saves them all kinds of money by investing in Farm Drop, you're investing in. And so that story becomes one where, like, you don't get the return of the money, you get the return of, we're going to help generate more investable businesses in the state of Maine for years to come. But that's,
I think that's a compelling story. And I'm as I'm thinking through this, I'm thinking, I'm not sure you need to quantify it, like crazy quantify it. That would be one of the things that for a lot of our investors would go in the plus column of why I would invest, because it's going to preserve farmland. It's helping keep the family farms going. It provides healthy food to the families of Maine. All of those other reasons, that's all part of the calculation that we each do internally. So maybe it doesn't have to be quantified per se. If there's a quantification monetization equivalent, I mean, you could do that, although I think it varies from individual to individual. But to say that, what Farm Drop is doing is more than just, creating outlets for the family farm to sell their goods, but it's also helping preserve lands and the like. I think that's very much a selling point.
Thank you.
Yeah.
I think we're out of time.
Yeah.
And this is a mark of a great presentation because we're 10 minutes over. So it means people were genuinely interested.
Ah,
It was really great. Thank you, Brian. It was wonderful.
Thank you, Brian.
yeah. Thank you
was
guys
great.
for listening.
Thanks.
Appreciate it. Yeah, yeah.